We've discovered you hidden in the Caribbean and got you back finally. You made an appearance on Twitter, and it was like there was no chance we weren't going to get you back on Real Vision. Hugh, how are you, my friend?
Yeah, I don't know how hidden I am, but certainly I've had my coming out moment.
So what are you thinking? You've obviously got something in your head because you've started to reappear on Twitter, and I know you've had a chat with Grant recently.
Yeah.
What are you starting to see that is capturing your imagination?
I had to leave the business at the end of 2017 because whilst I was passionate about everything, it was becoming a joyless activity, you know. But it did feel like exiting a little bit prematurely, and like I said to you, I spent a lot of time just going back over everything that came to pass. And I've now committed to the most attainable project for me. And I know it's grandiose and self-projection, but kind of like, the first step is always the hardest step. I could just hide. I lived this incredible, wonderful, insanely good life. And that could be enough, and I could just hide. But I kept having a sense of regret, and a sense that there were certain skill sets and like you should pursue them, and so the first project that I could do was essentially just talk to camera and do the 15 years of my monthlies. Because typically I was forming a contentious posture and waiting for everyone else to kind of come in and get it and share it and participate and allow me to monetize the idea. And so I was typically writing stuff where, again, I describe myself as being a schizophrenic. I heard voices in my head, and those voices, we sit there, and well done you, because you get it with your letters and things. Give me more. don't give me like the last 6 months chart. Like, show me 60 years, show me 100 years in you. And let's play with the moving averages. Let's do like 20-month, 40-month moving averages. Things that really don't cross that often. What happens when they cross? And let's ask 100 questions, And so, I had voices yelling at me. And then, of course, I had a super smart intelligence team who would then go out and try and find some underlying justification. But those voices were very strong 20 years ago, almost 18 years ago, when I set up the fund, 2002, beginning of 2003. I was a long short guy, but we wanted a macro fund because the world was set to kind of step out of that kind of territory into the wide, the voices were coming from disparate places. You were beginning to see commodity charts. Prices were no longer falling, and when you vol adjusted and you put them relative to other risk assets, they were no longer losing their risk purchasing parity, if you will. And then that took 3-4 years, and then they were kind of coming out of that saucer-like platform and beginning to have a trend. And it was like, and of course, this was the emergence of China on the global stage, and its footprint beginning to have influence on the pricing of these global assets. And that's what the voices were picking up. And I really went for it. And we had just, I put out an Instagram. So I did November 2002 last night, and I put it out on Instagram. And finance guys, they go to Instagram to look at bikinis. They don't go to Instagram to look at me. I'm thinking about maybe the next one I'll wear a bikini. I don't know. I'm really struggling. I've got almost, 10,000. I've got 9,000 followers on Twitter. And I think I got 1,400 on Instagram.
Yeah. Twitter works better for the finance crowd.
I don't know why, because like Elon Musk says that the broadband of video content is just so more immediate, and you can just put so much out there. It's not just what you say, it's how you say it, and then there's the background, it's what you're wearing, it's kind of how your arms are moving, etc. And unless, because I've still obviously to learn how to thread a Twitter, but
Yeah, that's hilarious. I saw that. Hugh's learning. I can see.
I'm sitting there and it keeps saying too many words. I'm like, what do you mean too many fucking words? Pardon, too many words. So then I'm like, okay, let's take that word out. And then someone sends me a message, dude, you got a thread? I'm like, what? But my understanding is, you can only put, it's old Instagram in the sense you can only do 30-second type videos, whereas Instagram has Instagram TV now.
Yeah.
So, but last night I did October 2003, and I was just saying, well, this was the chart set up back then, and this is what I started to do. We found this little company, Amsterdam Commodities. They weren't looking for investors. They didn't want investors. They were yielding 10%, and they had an earnings yield of 14%. So they distributed pretty much all of the cash flow, and they made markets in the most obscure little kind of condiment type commodities. But if you looked at it and you try to sell it, it's like whatever kind of thing. And I went on to say that kind of, maybe I just sat in the coffee shops in Amsterdam, getting high, because I tell you, that stock got high. That was 15 years later, and on the look back, that was one of the rock and roll stocks in Europe, one of the best performing stocks ever. I posted a chart. It went from, we were buying it at 80 euro cents, and it went to 15, 16, 17 euros. So anyway, so back then was the beginning. I never believed 2008, it's complicated, isn't it? So I being early and coming in, I then exited those trades way too early. I kind of brought down all the gold thing during the year 2005, 2006, because actually the big boring pension guys were coming in. That's when it truly lifts the thing. But if you remember, I was beginning to say, hey, look, I still believe in gold. I think gold does it. It goes to at least $3,000. But it's a Greek tragedy. You really need an intervening, profound deflationary shock. Yeah, and I was saying back then, the Fed's got to do a Bank of Japan. It's got to go to zero. So when the Fed was, the Fed was at 5.5% rates. I'm saying, look, gold goes to 3,000 if Fed rates go to zero. It doesn't just trend. Things have to intervene. And so, 2006 for 2 years, for the best part of 2 years, we were trying to capture the deflationary event, which we succeeded in doing. And then I truly, truly messed up, because I came in and I wanted to kind of bear a grudge that we bailed out speculators. We bailed out all the filthy people who didn't see it, who were irresponsible, who lost clients huge amount of their wealth, shrugged their shoulders, and went back to doing the same thing. And it's not for me to be the kind of moral guardian of the universe. And in being kind of fuzzy like that, of course, I miss China spending 20% of GDP, China saving the world. China just saying, here's the Marshall Plan. This is how we come out. We're going to save globally the world, and that huge rip. So gold, of course, gold kind of flips between being a zero coupon bond and just being like a high beta equity, like an overowned popular FANG. If you, it's a FANG or is an index linked bond. Right. And of course, it became a FANG in October 2008, and people were like, oh, and having to liquidate. And then they missed, of course, the march to the 2000 high. But I still think that the 3,000, who knows what the numbers are, but, given that I had been saying, I'd been pinning the donkey's ass at 3,000, I still see contextually now, everything I'm seeing feels like it's the third act that's unfolding. It's the third act.
So gold is the thing that is, the glittering of gold is the thing that's got your attention right now, because all roads lead to it for the moment for you?
Well, again, I have only, in the last 2 months ago, I resubscribed to the Financial Times as an example of just not being engaged. Yeah.
Yeah.
And I have to say the best part of Financial Times is the on the internet is the comments section on the big pieces. And yet so I'm not sitting with a Bloomberg, and I don't have I used to have this thing called chart porn, and I could load any index in the world or my own series, and it would be set up like with my specifications, and I would say, yeah, I want to look at this for 20 seconds, and I put 2,000 charts on that thing, and they would just repeat and repeat. And, it was like that was my meditation.
Love it.
So I've not had that, and yet the damn voice is like, I'm waking up in the middle of the night. Like, did you hear that? We got rats in the wall. What's going on? And of course, gold. We talk about, so gold flared from 2009 into the end of 2012. These dates better than me.
Yeah.
And then of course just had a stinking bear market. Had a good healthy bear market. It had a bear market of duration. It lasted a long time. It lasted long enough whereby the second and the most interesting part of the bear market was it just didn't do anything. It went sideways.
That was a big tell for me that the market
that's the rehabilitation.
Correct.
And then the second big tell is, like, again, once you put those, I was going to say you adjust for vol, but in the QE world that we may be coming out of, but the QE world of 2008 to 2019, it's almost like all vol converged to something very low, like 12-month vol of 8 to 10%. So I don't even think you've got to do vol adjustment on a gold versus S&P chart. And again, you could see that it was just slowly no longer, like we were doing back in 2002, no longer losing risk purchasing power, if you will, to other risk assets. And then you did actually see delta one direction. The thing started to go up. And this is all before, the the virus. So that's kind of the weird way that things work. That's kind of how the John the Baptist type, the heretics, something's actually happening. We're just not cognizant of it, and it's just the crazy people that are seeing it. And so that's where we were. And of course, then the virus came, and so in terms of just catalytic reaction, just the way they come in so hard and so big, and then of course as it's unfolding again. It feels like you're reading from the pages of Ayn Rand and how the government is just is everywhere and everything. And, we kind of know how that ends. So, yeah, that's kind of why I'm using initially just the forum to kind of, like a masterclass. I'm telling my journey, and I'm finding that cathartic starting at the beginning. And I'm finding, because people are kind of writing to me saying, so do you think this is we should be buying agricultural futures and other commodities? Kind of. I know, but gold is really not a commodity, yeah. And like I said, with the monetary authorities are doing this. They are the plumbing is at the level of the dollar. That's the intervention. They are intervening because they believe that will have a beneficial impact on the economy. Is that true? Probably. Will it help the stock market? Kind of. What does it mean for gold? It just means definite things. Take out all the subjective adjectives you can use, and just start saying words like for sure, absolutely, definitely. This thing is rocket fuel for the risk asset, which is gold.
Yeah, if you think about all of the voices in the gold world that have been around forever, the thing they all feared is now playing out in front of our eyes.
When you say they feared, what do you mean?
They feared that, and correctly so. I think all of us had the fear, particularly in the macro community. We just didn't always say gold was the choice at all times.
Yeah.
But what we saw is we knew we had a massive debt problem, and it hadn't gone away.
It got bigger.
We knew that interest rates were going to go down to zero probably in time. And that would leave a real problem, which we're about to face now, where we're about to have deflation. The market's not figured this out yet, but headline CPI is going to be negative 3, 4, 5%, and real rates are going to go through the roof, and the Fed are going to shit themselves. The only answer that they have is more. And so if you have ever been attracted to gold, the only one thing you haven't got is a dollar bear market. But I've been writing about this for a couple of years, that the dollar and gold can go up together for a while.
Yeah.
And then eventually, because in a debt deflation, dollars is what everybody needs, gold is what everybody wants. Or the other way around, maybe. Everybody needs gold, everyone wants dollars.
Yeah.
And
well,
so
again, it's the convexity of gold because it becomes the zero coupon treasury. It's the global treasury zero coupon bond.
Well, also in a world where risk parity there is no portfolio effect of owning bonds any longer. Why would you not own gold instead? This is Dan Tapiera, I think, raised this point. He's like, I don't understand why risk parity these days wouldn't be own equities and own gold, because it has some convexity that adds to a portfolio that bonds just don't have any longer.
Yeah. So my take on that, of course, remember I said to you, gold is like me as a schizophrenic, and 1 minute it's your friend, but the next minute it really doesn't like you. Okay. So I was saying to you that 1 minute it's profoundly short volatility. And at the other moment is deeply convex, like a zero coupon bond. And so my take on it really would be that you want to marry a gold position with a long vol position, and which is easier said than done. But it may be becoming easier to own volatility. But I say maybe. I really don't know, and it depends on what happens next. But so we've said a lot about gold, but I have to say, so gold was my fascination in 2002, and I kind of erred somewhat. Without a doubt, I erred in after 2008 because I won in 2008, and being up, I don't know, 32%, and I could just put the bank and just owned 100% long gold at that point, with vol at 60 or 70, and I did. But I want to say, the thing that has obsessed me, and it's another thing which motivated those tweets and my kind of the reappearance of my public persona, was these very, very rare events when volatility goes up with stock prices. And as far as I believe, or I can say, it's only happened in Weimar, and like those, like the kind of really weird stock market places like Venezuela and Argentina.
It did happen in '99, right?
I don't know if it. I know for sure it happened in Japan. I
remember trading 100 vol equities in '99 in the blow-off, and it was extraordinary. So that's the only other time I've seen it.
So tell me more, because that, I don't recognize that data point. So you're saying 1999. You're saying in the midst of the tech bubble, as we were just approaching the final surge, you had vol going up.
Yeah, and we saw those some of the tech names trading 100 vol, which was extraordinary at the time because it was in a bear market.
Yeah, but you're right, because the 1998 to the finale was punctured with 50-60% peak to trough corrections in those positions, which gave them. But what I want to say is that they were rising with a high level of volatility. Okay, and so when they had that if you will, that normalized volatility was an average of the vol went to 120 when they halved, and then it reverted when they went back up. And what I want to say to you that is that actual surges in stock prices higher, because I spent a lot of money researching this, and maybe other people watching this could come back and lend any of their observations if they can. But I am pretty sure that the only time since 1987, the crash of 87, the only time, maybe it's the only time in terms of a stock index, that the stock index went higher and vol surged higher at the same time, was with the when what's he called, the Japanese Prime Minister, Abe-san, because he'd been Prime Minister like a long time ago and was discredited being too nationalistic with the whole Second World War and stuff. And then he got reinvented and he came back with his 3 arrows, if you remember.
Yeah.
And the Nikkei and topics just went boom, right? And vol went boom at the same time. Now, for sure, there were some special factors because Japan, being first into zero interest rates, had been the first financial society to weaponize vol into a fixed income security. Yeah. And so those obaidashi, I want to say, instruments got caught by, everything went wrong at the same time. But even over and above that, there was this remarkable moment. And we'd been looking at a trade, and we then put the trade on in 2013, just saying, well, okay, so it's happened. And it's not, I was going to say the unthinkable. There's no rule of nature that says vol can't go up with stock prices surging higher. It's just that it's really never happened. The only point being that Japanese experience. And so the genie's out of the bottle. And we sat with this. It was the most insane. I'm going to try and flesh out the position we had and try and put it on Twitter, maybe today or tomorrow. But if we had, so you kind of, the skew puts are always, way out of the money puts are always like 2 times more expensive than calls on the indices. But you kind of, and why? Well, why? Just because of the observational data that kind of like equity vol surges when prices fall, so the puts are more expensive. If that world changes, then you can sell those out of the money puts. You can buy so much calls, but then of course you had to structure it whereby you couldn't be naked to being wrong. So that hence the complexity. And then there was it required a lot of carry, and so we had to engineer and we had to trade to create the carry. But if stock prices had moved 20% quickly, we had, gold is fantastic, but this position, rock and roll. And this is the position that really Chris Cole, from Artemis, the volatility trading kind of platform, that he had written up. If you want, like, my favorite ever independent thought piece on the stock market was Volatility at World's End by Chris Cole. And that's what I wasted a year trading that early because, of course, Japan was in the midst of the vol regime of 2008 to last year, and of course vol just went down, and so that trade was a negative carry trade that just did nothing. What if in this world, like you say, we like with the deflation that's coming, and therefore what the policy action is? Does that mean that volatility is just continues to just be subdued, or does this mean that we move into the new world with the new post-virus world is a world where just possibly volatility may lose the prejudice of people's expectations?
And does that mean that you're suggesting that in this environment there could be a surprise in the fact that the equity market goes higher and not lower?
Well,
because in the end you're owning an asset that maybe has some value perceived against the debasement of the fiat currency, for example.
Yeah. So that's really hard. So during that Japanese period, so let's link 2 things that I said. That Japanese period, I became obsessed by a book. And I want to share way too much information with you. So my wife bought me a T-shirt saying, I think my husband loves me, but for sure he loves St. Paul's even more. It said something like that, and she went back to London with the kids, and I was like, I mean, I've got to go surfing. I've got to be close to the beach, etc. And so I think there was one like February morning. It's dark, and she was feeling quite miserable, and she decided to throw out my library, my book collection. How painful is that? I mean, like, I'm sure the audience knows the pain that we're talking. Now, my wife's wonderful, and I had it coming, but I lost. She threw everything. Oh, I went to the charity shop. I mean, rare book. I mean, you name it, like 200-year-old tracks on gold, everything went. And like I said, but then I said to you, part of my re-engagement was the internet subscription to the Financial Times, and I was reading the commentary on Gavin Davis he has a piece weekly, and I was reading the commentary, and someone said, "Hey guys, you just got to watch this YouTube video. It's based on a Japanese book." I'm like, "Oh, no." And the Japanese book was The Princes of the Yen. Are you familiar with that?
Oh, I'm not. I'm writing it down now.
The Princes of the Yen, and I think it's by Richard, like Weiner, something of that nature. Anyway, I read that book like back and forward, upside down, from the middle to the ends in reverse. It had such a profound impact, and clearly I wasn't alone. And some dudes have made a 1.5 hour video montage, and it's amazing. I like you don't even have to read the book now. Just download on YouTube The Princess of the Yen. Okay. So back to your question. So I provocatively, and I was maybe just playing data traffic and stuff. But I kind of said, hey, look, if you're one of those types that says we go back to the all-time highs in the S&P, so that would be what, 3,200, 3,250. Well, I'm like, okay, you're a hero. But actually, a world where that's the default position is a world where you're not going to 3,200. You're going to 2x, 3x. Okay, so you're going to 10,000 on the S&P. Now, easier, actually kind of complicated to write that given the constraints of Twitter. Yeah. But that aside, okay, let's return to planet Earth, because what's missing from that? So we know that we know that they can see that this is deflationary. They've announced, I think, globally $8 trillion in fiscal spending. Yeah, 10% of GDP. But we know that actually that's the tip of the iceberg, and that the monetary module behind that is probably 4 or 5x. That's just a really, really big number. Okay, and so you print a lot of money, and that money bids up assets like gold. Is kind of where we leap to, and that's where I can then say 10,000 on the S&P. But it's like, hold on, because actually you always require exuberance. You need a monetary mechanism, and that's why gold actually failed at 2000, because it when we had that move from 2009 to the end of 2012, Niall Ferguson was out there saying America was going to be Weimar. Why was it not Weimar? It wasn't Weimar because the money that was printed had no velocity.
Correct.
Yeah, and that's still the obstacle. And so back when Japan and the Princes of the Yen, remember the money, they really changed the monetary window in Japan, and the central bank was just telling the banks, expand your balance sheet, expand your balance sheet, expand your balance sheet. If you're not expanding by 15%, we're going to do a bank review, and I'm afraid you're not going to make it. We're going to insist that some of you lose your jobs. So like these guys, bum, bum, bum. And if you watch the video, because we think that my take on that was property prices went crazy, and kind of normal people were very fearful because they were having to take 100-year, 150-year mortgages. And from on the ground, from the intel from the books, like, people couldn't believe it. People ended up owning 2 houses, 3 houses, 4 houses, because the banks just had to lend the money. Okay. So I think you had 15% per annum. So that is to say bank loans were doubling every 5 years.
Which period was this?
86
Right.
into, so the, Nikkei to 40,000.
Yeah. Okay. Got it.
Yeah. Okay.
Yeah.
So that's the periods. So like I say, if it's one thing to do on a 90-word tweet, whatever, 3x S&P, so 10,000. There's a lot more detail. So actually, so you can sit there and just be right with your thesis and say gold is it is the world's zero coupon treasury. It just it's not soiled by, it's beyond sovereign risk. It's a global thing, and it's the greatest convexity you have to this world of deflation, and gold is going up, and I think you've got enough evidence. I think everything's on your side there. For me, I am just so intrigued by how much more money you can make if we are talking about a world where the vol regime is going to shift and change and like really become funky, because we're not prepared for that. And like a real example, and I didn't just disappear. Okay, I was at, because I want to think I'm a smart guy. I actually concocted my personal trade for volatility at the end of the world, and I'm living. It's like the Truman Show. I am sitting inside a gold box. I think of not just owning a security like gold. Think of actually being that security.
And Hugh, the reason I'm here is exactly the same.
Exactly.
It wasn't a coincidence I bought a place on a small island in the middle of nowhere.
Yeah. No, hey, are we going to start singing Oasis? Hey, you and I, we see things differently. You and I, we're going to live forever. Is that where we are? I'm ready.
Yeah. But you and I know we can fuck up badly as well.
So for me, like you, so following in your footsteps, you pioneered this. But for me, last year I borrowed 5 million euros, 20 years fixed, and I paid 2%. And 2% was the wrong figure. It should have been like 1.3. But I was like, whatever, hit me. So let me just say that again. I borrowed 5 million euros to buy a property in St. Bart's, to buy a part of believe me, it's a much bigger investment than 5. And a French bank was willing to lend me fixed. Okay, that's very reminiscent. So that is assuming your world. That's a world where kind of gold is going to kind of go to 3,000. It's going to go to 3,000 because it's going to be difficult. But there's enough financial lubrication that it won't be the 1930s. But it's going to be a world of zero interest rates for a long time. And I just don't think that the banks are as smart as that. I think they've got that wrong, and I think they've got that wrong like their German cousins after the First World War. Yeah, so Germany was devastated clearly after the First World War. So was Japan after the Second World War. Yeah, and yet within 15 years, Japan was had very quickly emerged and was like approaching the income levels of the West. Maybe 15 to like 20 years, 25 years, it was there. So the fact that you're decimated, I hate that word, decimated, you're destroyed by war, financially, your central bank turns around, your banks are bankrupt because they own worthless pieces of paper. But actually, as a central bank, you can say, okay, give me that worthless thing and I'll give you $100 million for it. And they're like, but it's not worth. Thank you very much. They're like, you're giving me 20% of Hitachi or Toshiba or Sony or whatever. Presently it's worthless, but give it to me and I'll give you this worthless piece of paper called the yen. Yeah, and Japan reemerged, and so the same dynamic was happening in the German economy after the First World War, and then like now, you could come in. You had to be wise. You had to buy the right asset. And you've been great. You've preached this. Buy something tangible, real, that throws off cash. Yeah, and it's you've got a lot of data. Like it throws off cash in good times and bad times. I don't like cosmetics. People get depressed, and they have to look really good in depressions, and they have to look spectacular when life's great. I don't know, but it throws off cash. And then you sit there and you say to the bank, "Hey, hit me," and the bank's lending you 5 million, 10 million, 15 million, 20 million for 20 years fixed, because it sees a world where interest rates are just, they're anchored, and they're never, if anything, they're going lower. And so I want to be the other side of that. And here in St. Bart's, I develop. I'm going to share. Actually, I'm going to share some of the properties, the projects that we have. But we do uber luxury. To the uber creditor status. The guys who the princes of the world who own the world come and they there's no point having a private island. If you're in a private island, no one can see just how amazing your intellect and how amazing your courage is. Yeah, you got to come. Like here on New Year's Eve is the greatest concentration of like the most grotesque giant super yachts in the world, and it's like a caravan park. I've been on these things. I'm like, I could pay me to stay on these things, But, I get to own very, very, and again, a bit like gold, they don't want any more construction on this beautiful island.
Yeah.
And they're making, each year, they change the civil code, or the code of urbanism, and they make it harder and harder to build, to develop. So my first project, we did 550 square meters of internal space on an acre of land. If I did that project today, I would get about 300 square meters. So this thing now is unique. Okay. And so scarcity value, one of a kind, if anything, is diminishing in terms of the supply is diminishing. And then and no currency risk. This is a euro asset. I'm funding in euros. I'm funding it. And the next deal, my bank. And so the bank calls me, right? You can't really say it, but I feel like I'm having a good confinement. The bank phones me and says, just thinking, like, the French government, they want to help. I'm like, they want to help me?
They want to give you a break on your mortgage.
They want a 6-month break. And I'm like, what do you think? I'm like, yeah, why not? That's fine. Hey, pourquoi pas, mon ami? Merci beaucoup. Anyway. And then I got an email, and he's like, from our friends in the government, they're willing to make a loan. They will lend you 20% of whatever your average loan balance was last year. No capital repayments, an interest rate of 0.25%, and probably with the right to extend maturity. Is that something you'd be interested in? So I was like, yeah, that's something I'd be interested in. So, so I get to live when we have a hurricane, when we have a virus. I get to live in these gin palaces. Yeah, normally these are commercial projects, so this is not my real life.
Yeah.
But I get to own these exclusive rare assets. I think funded at the wrong rate, and then the ownership cost to me is zero, because this is the longest holiday letting season in the world. We get 26 weeks a year, and so the clients pay for the financial servicing of the property. So
there's no additional yield above the cost of finance, but it's free carry essentially, including maintenance.
The first few trades, the positive carry was insane. Before the virus, we'd bid away the positive carry, and we'd gone to break even, include everything, maintenance, everything. Yeah.
Right. Okay. Good.
And I think the virus, and if I get assistance from my friends in the French government with additional loan facilities, I could sit, because my dream is I think I put something out saying I'd kind of like to do a property fund here. Very hard to do, but my idea is I want like very long, very patient money. I want to be the central bank of this tiny little island, so that when there's a liquidity issue and someone's got to sell something, and they've got to sell something at the wrong price, I make the price, and I clear the market. Still thinking about it, but there's just a chance that the virus changes we might be able to restore positive carry back into that trade. But that's the kind of, so that's my thing. That thing blows out insanely in a world where the S&P goes to 4,000, 5,000, 6,000, 7,000. And that's not a world which is healthy. That's not a world where ordinary people feel happy. And that's the world that you understand, that you're conjecturing.
The person who's been propounding that theory, you know Brent, don't you? Brent Johnson?
I think I know the name, yeah.
Well, he's on Twitter a lot, and he's been on Real Vision a lot. He's a good friend of mine and Grant's and stuff. He has the dollar milkshake theory, and his theory is a rising dollar and rising equities based on bad things, not good things.
Yeah.
And I have some sympathy for that view. I also think that what's interesting is, regardless of what the equity market does, gold or your Caribbean gold box works as well. Because in a world that, let's say, goes towards where I think it's going to go, which is a longer drawn out depression of some sort. So we have a big GDP fall and it stays low for longer, like we've seen in Italy and we've seen in Spain.
But it's like I want to call it the gilded depression. Because it's a world where you get universal credit. It's a world of 20% unemployment, but the state is paying you to be unemployed. Or to differ? Do you think it's different?
No, it's possible, but I don't think they'll pay you enough. So therefore, cash flow globally falls, which I think leads to the big insolvency. But
can we just stick on that narrow point for a second, because that's really of the moment, in the sense that the initial intervention by the US Treasury, where you made available, I want to say, like $650 billion for small enterprises. And then you had $1,200 checks to the individuals, to the workers. And of course, you were ready for the surge in unemployment claims. And so you're paying the unemployment insurance. As I'm sure you read, the small enterprises are returning the loans because they're saying, well, 80% of it has to be spent on paying salary. And if we fail to spend that, then you want the money back kind of immediately. And we kind of don't know for two factors, because there's going to be social distancing. We don't know how willing people are going to be. But secondly, I can't get damn staff. They're happy sitting at home because the unemployment check for now is better than kind of cleaning the dishes. And that's a messed up situation.
Yeah, but also, in the end, to paper over a debt crisis or a solvency problem with more debt is not the answer. You're the flip side of that, right? So you're able to service debt, and therefore to take on more debt is great. I remember my old boss, Noam Gottesman, back in 2008, borrowing a shit ton of money because he knew he could. Now, nobody else wants that debt. So my brother-in-law, who owns a restaurant in Asheville, North Carolina, sure, you can give him, and he's a great chef and it's a good restaurant, but to give him more debt terrifies him because the debt is the issue. So there is a velocity of money issue. Huge, and again, it's a reason why St. Bart's property goes up, but other stuff still falls. I think I still worry that there is a solvency event, and maybe somewhat from the gilded box, you don't see it as much as it would be.
Oh, for sure. But then I was listening to you intently, and I felt you were prejudicial in the way that we've all felt ourselves be prejudicial in our understanding of macro and crisis. What's the amazing book? Panics, Manias, and
Crashes.
Crashes, yeah. Kindleberger. You can't be a global macro manager student wannabe without like being able to recite it chapter and verse. But we lived in a world where actually it doesn't. The linkages and the causality haven't happened, and it's being kind of replaced. God forbid. But we live in a world just now where the dominant ideology is, what is it called? Modern monetary theory? Is it MMT?
Yeah.
Or is that what it's called?
Yeah.
Because it's so, I'm a little bit out of it in terms of the MMT or what have you. I keep calling it PMT, but I'm thinking of something else. What I want to say, because you're saying the solvency event, right? It's not right. It's not proper that you can just spend your way out of the crisis like we did out of Lehman from 2008.
No, I don't.
It's not right.
No, I don't argue that at all, because I actually do think MMT is much like the New Deal was. I think it's doable. What happens to the currency markets or the price of gold in that? Okay, that's great. That's a great macro equation for us to all play. Can a massive fiscal stimulus that actually rebuilds and does create some productive use of assets, new assets, let's say, yeah, I think that could work. What I'm saying is paying somebody 20% less than their income to give them a subsistence living destroys cash flow for companies that are already in debt. So my fear is that playing out with a very little time. I mean, basically, everyone blew through all of their savings in 1 month, including every small business. So,
but take me to the edge, push me over the edge, because you said solvency. Describe the solvency issue that says, I'm coming in and I'm cleaning this shit house, okay?
Yeah. So
how does it end? Because I don't see, I'm not smart enough yet. So I'm listening.
So the solvency event for me is, I use the restaurant because it's the easiest one for us all to understand, because we go into them all the time. So if you go to China right now or Singapore, there's social distancing in restaurants. So they've reopened. Hurrah! Equity market rallies. And there's been some subsidies for people to keep them afloat. Most of that is in form of new debt. There are some cash handouts too. But you open your restaurant, and here the magic happens, is you can only have half or less the number of customers. The moment you open your doors, you have to pay staff. The moment you open your doors, you start puking money. When you furlough your staff and negotiate with your landlord to not pay rent, you can hold in the deep freeze for a period of time. You reopen, you're fucked in a couple of months. And that has a knock-on effect, right? So everybody gets tipped out of jobs because you're going to downsize the number of restaurants. That's okay. That's how the cycle works. But the problem is that happens at scale because of the unemployment, and you've got unemployment benefit of which people are starting to save. I think you're likely to see the saving rate rise because of the issues the behavioral and emotional issues people have faced from this. They're not going to go back and open the balloon.
I don't think they will not have the means to save. They won't be earning enough to save.
Okay, fine, fair enough. But the chances of consumption going back to the same level is unlikely for an extended period.
Okay, but then can I say to you, okay, so that I I fully get that. I can see that happening. And so, I'm like the new Chancellor of the Exchequer. This guy's incredible in the UK. He's like, what's the problem? No problem. Let's just spend, how much do you need? No problem. This guy's the most popular politician ever. And he looks really nice. He always smiles. What's the problem? No problem. Okay, so I'm going to role play that. And you've just, my smile, I'm like, oh my God. But I'm back being, what's he called? The UK Chancellor? It's an Indian name. I don't know.
Oh, yeah.
Sunny, the sunny disposition. He says, okay, hey, the problem here is so you open and you hemorrhage. So don't open, just furlough. And so then you say, yeah, but okay, so these are low skilled, unless they were talking about the restaurant and the kind of lower skilled elements of that. And they sit there on unemployment or universal credit. And so I'll problem solve, and I'll say, the problem with that scenario, universal credit's too low. I'm gonna double it. Okay, what's your problem now? Okay, so and you said, well, how are you going to fund that? No problem. Are you serious? I'm sovereign. I'm UK. My government debt to GDP is 100. I look at Japan. Those crazy guys are at what are they? They're at 220.
This is beautiful, right? Yeah. So this is where constructing a macro theory framework or portfolio, you have these two things, right? You have an insolvency event, or you have a massive transfer in some way, shape, or form onto the central bank balance sheet. The government and then the central bank, right?
Sure.
In both those equations, there are certain bets you can construct that have high probability outcomes, which is where it gets interesting, where it doesn't matter what happens, we just know it's going to be extreme. So therefore, go back to the beginning of our conversation, the probability of gold rising strongly and further than most people expect is extremely high. It's as good a quality macro bet as I can think of.
Absolutely.
It is also intuitively what drives me, and I don't think you've gone down the rabbit hole yet, to Bitcoin, which is another one for me that I find you'll get there, I promise you, and you'll end up.
I see you're still 27% down on your
That's
Bitcoin.
Right.
Eulogize it when you're making money, but anyway.
Okay, do that.
Eulogize it when I can explain it, but anyway. Forgive me, that was mean. I didn't mean to be mean.
That's all right, because I already made 10x the first time around, so 200 to 2,000. I sold out early, went to 20,000. So I made 10x and felt like a dick.
Hey, do you know that thing made that thing made my life a misery, because I was doing a presentation and I thought it was like just clients and there were kind of newspaper hacks, and I just speak kind of I shoot from the hip, and I was talking about, I think I said this in 2011 or something. And I was talking about 2012, 2013. I was talking about a world, everything goes up, okay? And someone said, what about Bitcoin? I'm like, Bitcoin goes to like $1 million. I just meant that metaphor. It goes up a lot, right? And like, on my grave, it's going to say, here's the guy that said Bitcoin is going to, maybe it will, but
you're like a genius.
But I got such a hard time. And as you know, it went from, I don't know, 600. No, it went from 300 to 1,800 or more.
No, it went from 180 to 20,000 in one run.
And I said, my comment, I think, was about 600, 650. And I said, it's going to go to $1 million, but it's going to go up a lot. So that's, I just like, whatever.
So I'm interested again to just think through this, right? Because we've got two potential outcomes and neither of us claim to know which one outcome is going to happen. I have a hunch on one, you may have a hunch on another, whatever way. So we've got this theory about gold. So what else do we construct around it? You've got an interesting idea that potentially in one of these scenarios, the equity market goes up a lot.
Yeah.
Okay, and of which the upside in, so wildly out of the money calls in the S&P, and I'm particularly interested in the S&P because there is clearly an indexation effect going on. So you're playing that. And there's clearly a situation where smaller businesses will fail versus large businesses. There's a land grab going on.
And you get all of that.
So you get all of that with that call option. So that's I think, it's a very interesting bet. I also think that.
But then I say you've got, but remember, it's negative carry. You've got to fund it. And I thought, remember, I haven't managed professionally money for a long time. And what I did like was, why not fund? Because you can buy 5,000 2021 calls on the S&P for nothing, obviously. But, nothing, if you're a hedge fund, is like 25 basis points that as soon as you trade, it's going to be marked at zero. And so you're going to lose 25 basis points on one position on one trading day for just that kind of small position. And then you're going to have to refeed it every whatever, But given from what you've said and the impetus of the monetary response and the dollar monetary response, sell volatility on the dollar cross or sell volatility in fixed income. Because we know that because the two things about modern monetary theory is actually you can keep expanding the franchise of the central bank's balance sheet. You can do that to infinity unless you lose control of the currency, and or typically at the same time your yield curve steepens. Okay, but if those two events don't happen, like back to my point of let's just double universal credit. I can just keep kicking this into touch, right? Because maybe when we get to Japanese level, with all of the spending which is baked in by the US Treasury and with the slowdown in GDP, what are we talking about? US debt to GDP in 5 years' time? I think it's going to be like 120% of GDP. So 100 percentage points less than Japan. And so that's what I keep coming back to. A gilded depression.
I don't disagree with that. So here comes another output that I think is interesting, right? So my preference is on the deflationary solvency event. Okay, fine.
That's your gold position.
So, well, yes, but I think gold works in both. But we've got equity side of the equation that we've talked about, which is an interesting bet that's not priced in. The other side that's not priced in is the opposite bet, which is the negative rate bet in fixed income. It's actually really cheap to construct option strategies around it. You know, I've been looking at on 5-year futures. You can do it on Eurodollars, whatever. You can do these butterflies that pay out 20, 30 times your money if they have to bring interest rates. So in the situation where they're going to do massive monetary printing, we also know they're going to try and keep interest rates as low as possible so it doesn't cost them anything. They're not stupid.
Yeah.
Right? So therefore, the probability in both scenarios of negative interest rates or zero, pinned at zero to negative, I think is a tail that's not priced. So that's interesting, costs you virtually nothing to do as well.
So I agree with that. So essentially, we've got a kind of triangle. We've got like equity, and it could go anywhere. It's just this crazy, you know. It's a funky reggae party, to quote Uncle Bob Marley. But it's kind of underpinned, if you will, at the base of it is fixed income and the currency, and that's MMT, yeah. And we know that the impulse has they will go to all lengths to ensure stability at the core of the pyramid. And if going to all means taking those rates negative to stop the yield curve changing,
or the dollar getting too strong,
then so that's why you need. I think that's genius. If you can put those trades on, you have that, and at the same time you can do my trade and buy those deep out of the money by selling vol fixed income.
Yeah, we need to solve that part. Is where can you safely sell something to pay for both of those very cheap bets? Because gold is your core position. I'm not yet sure what carry you can take to pay for it, because the uncertainty of the outcomes makes carry unattractive to me.
What? Well, yeah. I mean, for sure. But that's why presently I'm sitting. You know, maybe the economy is going to change. The economy, anyway, whatever. For sure. For sure.
Property is a potential carry.
That's my trade just now, because as I said to you, I've got I don't like the pricing that I'm confronted with just now in my tiny little bubble universe, because my convex trades are flat carry, so there's zero carry. Okay, whereas when I started, I was getting earned to put the trades on, and if I get a kind of short-term reversal in prices, maybe I can get a positive carry convex trade. That's what we're seeking. What we've just discussed, what we've outlined as a possible portfolio structure, is a desire. So gold doesn't give us carry, and we're talking about just being delta one long there, and then we're saying, why not have a look at these out of the money 5,000 strike S&Ps. We don't want to sell, because you could sell a 1,500 S&P put. My God, you could buy so much convexity, but you'd never make the journey. So that's out. So then I'm coming in, I'm saying, let's sell vol on fixed income and on the dollar crosses, because we know that the medicine men are going to, that's not going to be a market rate. That's going to be a rate determined by bureaucrats. Okay. And we put that together. And so the question is always, don't tell me what happens. Don't tell me we're traveling from A to B, and don't eulogize about point B. Just tell me about every twist and turn in the journey from A to B. So what are the secret risks that we are underwriting in that trade, which could flare at inopportune moments and take us out?
We don't mind losing the premium on the fixed income or the equity bet, right? Yeah. on the gold bet, okay, that is the core basis of the bet, but we think in all outcomes it's a superior trade. So the probability of losing money is relatively low.
The probability of losing money on the gold trade in terms of the vantage point of the destination, right, is like you're just going to make money, okay? However, like I said, there's going to be moments when gold is not a zero coupon fixed income deflationary trade, but it's a FANG, and the stock market wants to go down because the geniuses that kind of manage your money have recognized that actually it's not that bullish that confinement is over. It's not that bullish as businesses open up and actually have to stop again, okay? And the stock market heads down, right?
Got an idea. What about your old trade? What about to buy gold versus the stock market? Because we already own the upside.
Yeah.
But we know that gold is cheap compared to the market, right? So we do the relative trade in long gold, short S&P, or make it even easier for yourself. Make it the Russell 2000, so it's less concentrated in the big names. And then you own those two wing bets, and maybe that covers that.
It does. It covers that. But then what happens is, so the wing that you're then exposed to is my notion of the German bank, or my French bank lending me money today, but the German bank kind of was on the recovery mode back in 1918, 1919. And then we have the Treaty of Versailles, and we have this reparations demand for gold. The victorious French are like, this is serfdom. You're going to be our slaves forever, and you're going to transfer 20% of your GDP every year to us. And you get this. You end up, the Germans have got no choice but to debase their currency, and in debasing their currency, you get the Weimar like asset price inflation. I don't want to be short the S&P and long gold in a world where the S&P might be going to 5,000, 6,000, 7,000.
You've already got the call, and gold's going to go up in that situation.
But you've got the call. True. Yeah, no, true. You've got the call.
You've got the call, and you're long gold.
Okay. Yeah. So what you're saying is actually the one risk one of the biggest risks in the trade is the principal delta one position.
Correct.
It's Frankenstein. It's either zero coupon or FANG, and so you're trying to dampen that kind of flicker.
Yeah, to give you a better chance of letting this play out. Because as you and I know, it's very easy to be right in a long-term view. It's fucking hard to do it and hold on to the trade in the middle.
I still think, but I would maybe suggest, like, just don't supersize the delta one gold position, or just own it, but not supersized, right? And I think that your the convexity from your negative interest rate derivatives, I think they will flare. They will produce a P&L at the moment when gold becomes Absolutely. Like a FANG. Yeah,
they should do. They should do. Yeah, because the probability of negative rates goes up massively in a falling stock market. We know that because there's a reaction function from central banks as well understood. Yeah, that makes sense.
Yeah. So what we're demonstrating as two old geezers is that in managing and thinking about the taking risk on behalf of clients and other people, it is not just a question of how much we're going to make, how much do we need to make. It's a question of safe passage. It's I've got to be able to sell this view, this it's like being for sure I'm a piss artist, but I like to think of my artistic endeavors. But I start with it. We started this conversation with a blank canvas, right? And we kind of we squiggle there. And now what we're doing is we're trying to convince a group of wealthy patrons to participate and sponsor our view or our multiple views of scenarios which may play out. And we're going to sit there and we're going to curate and we're going to take good care of that beautiful painting that's going to enrich all of our friends.
I think it'll be fascinating to people to watch this, is how that portfolio construction thing is not straightforward. It takes a lot of time. And, you and I, yes, we've thrown together some ideas here, But there's a whole lot of testing that needs to be done on something like that, because you're trying to construct a long-term view that needs to be robust enough to be able to hold the position. And that takes a lot of analysis and time and thought and kicking the tires and saying, what if I'm wrong and where am I wrong? Because it's always
the majority of your time is spent on that. Like 20-30% coming up with smart ideas. Like smart people are dime a dozen sort of thing. But being able to program it into a machine that can actually give you safe passage. Managing other people's money, and the type of person that chooses to manage other people's money is a kind of traumatic experience, or it can be. You do spend you persuade yourself that you're having near-death situations, which is ridiculous. It's like you wake up in the morning and go, oh shit, I'm going to die today. They're going to kill me today. And it's ridiculous. I mean, of course, it's part of it's what creates the drive. And
it's kind of what you get paid. It's also kind of what you get paid for. You have to feel sick on behalf of the customer, right?
Yeah, exactly. So I for sure, I can't bitch about it. But when you stop and you're no longer, I guess, flooded with that chemical reaction, and you get time to reflect, you kind of, go into a kind of funny space, a time of reflection. And so I kind of went through that, and I was saying to Grant the other day, I think I went from being a kind of so-so hedge fund manager to being a really good villa manager. But when it came to the New Year's Eve parties on the island here, I think I was receiving the invitation for villa managers and not for rock stars. And so I thought, after 2 years, I guess your ego fears that you're becoming irrelevant.
Yeah, it's a weird life. I mean, I did it when I left managing the macro fund and moved to Spain. You suddenly lose a lot of what your identity originally was. It's good because you can rediscover yourself, but you realize that part of you is driven by that adrenaline. That kind of dopamine function is so strong within us because it's all we've known.
It is. And then, because I spent a lot of time talking it out, if you will, my favorite metaphor has been that, the glass jam jar, those beautiful glass jam jars, and as soon as you wake up in the morning, it's filling with sand, and the sand is all the noise, all just the kind of unsatisfying things in our daily life, and the challenge is to get to the end of the day with little pebbles of dopamine, and that dopamine, like you say, it can come from like just hitting it out of the boundary with the trade which you've long reflected on, and it's sat in the portfolio, and you've had that moment where the moment has passed and you've been able to monetize it. Wow. And of course, that's kind of shallow and superficial. You can get the dopamine release from someone like holding a door and smiling, and it's remarkable, those tiny little things. They're just as powerful. They take up the same space in the jam jar. But if you get to the end of the day and there are no pebbles in your jam jar, kind of you're beginning to lose your vibration as a person, and therefore you're not resonating happiness. You're just not an interesting person. And I fear that's where I was. That's where I was set, and so I was overcompensating with surfing. I'm still the world's worst stand-up surfer, which is just not sexy, but and various other, like, the mind is still overactive. But I feel like this year I felt like I want to just participate again, and be subject to that, the joy of having a random life.
And you've got a formidable intellect, and you have to use it. You can't not. And especially when I always refer to it as the beautiful puzzle, which is what we do in the macro world. And when you end up in a situation like we're in now, you can't not use it. That puzzle needs to be solved, and you need to be part of that conversation.
Yeah, my wife keeps saying, "Shut up." Again, I'm like, this is. I've been an analyst all my life. We deal with data, and my success, if whatever success that I have enjoyed, has been not cocking a snoop, not showing disrespect, but showing a respectful kind of a fear of experts. Experts are just consistently always wrong, and my hedge fund career, I put myself at a great distance from experts, and experts from all walks of, typically from investment banks and like going to industrial experts. And I tried to make it as hard as possible for them to reach me. And then I saw opportunities where there was a disconnect, because clearly there was an expert, again, let's use that word, who was putting this message into a marketplace which was resonating with the community, and it was coming back to you all the time, but it wasn't there in the chart. So there'd be a bullish resonance from the community. People would be talking about it, but then you look at the instrument and it'd be trending lower, or vice versa. So experts for me have they've been a source of, they kind of make me angry, because I go, really? I want to ask you questions, and when I press you, and then I've typically found opportunities, and here we are, and it's not our financial portfolios, but it's our lives that are presently being largely controlled by experts. I keep saying, I always kind of want to say I failed, but it was like, it's like someone was recommending that book by the female poker player. I can't remember her name, and just making the point that sometimes you sit there with the best, like what seems statistically like it's the best hand, and you still lose. That there's still an unknown quantity of luck, like just bad shit can just get in the way, and the measure of great traders is not to believe the kind of, I'm a moron because I sat there with a very strong hand and I didn't make money. Like, even with the best hand, you're not guaranteed. Like, shit can happen, and the lucky guy next door, he wins. But if you lose that discipline, when you come back and you have those three cards again, and you don't play it because you say, but the last time it didn't work. That's when you've lost it.
Because it's like, it's the reality is sometimes you see an 80% probability. I think this gold thing is something like a 70 or 80% probability, I would say in my mind. There's a 30% chance of being wrong. And that's a pretty big chance of being wrong.
And I was wrong the last time. Who cares? It's a 70, 80% probability. It goes in the book.
You do it again, and you do it again, do it again. And over time, you'll win. Hugh, look, as ever, amazing to sit down and have a chat. It's been too long. And look, I'm going to get you back on a few times, because I love just thinking through things with you, because, you're a unique thinker. And I think with the benefit of distance, you gain great insight. And I honestly think it's one of the reasons I love being here in Little Cayman. I write GMI from here. I live mainly in Grand Cayman. It's because I'm away from the noise. And the noise is the hardest part of this game. The best part is the thinking. And the more time you get to think, and that's why, I just knew you'd have some fresh perspectives that I just wanted to hear.
Well, if I could just ask for a little commercial plug myself, because, I don't want to manage other people's money. And I'm too damn lazy to do what you do. Like that piece that you put out all the time, I only have respect for the effort. Like, that's a tough gig. But my thing was always, son of a truck driver, is like, give me your best shot, give me your best trade. And what we're doing is peer-to-peer trade review. Yeah. And what I'm thinking about is I kind of want to do a form of consultancy, very confidential consultancy, where as a CIO, and our CIOs are getting younger and younger, you can pitch me your best trade confidentially and say, what do you think? Like, do you think I've got enough information? How would you do it? I don't want to manage your portfolio. But the thing is, I'm probably the only person, there's no one else in your organization that's going to say, no. Your clients are not going to kind of say, they're going to say, yeah, whatever. You need one, and I'm not to say I'm always a doubting Thomas, but you need it goes back. There used to be this legendary macro conference where, people like Alan Howard would stand up with they pitched their best trade
The
to a room.
Drobny conference.
Yeah, Steve and Andrew, you pitch the bet. Why would you do that? You do it because A, you've got it, so you're front running, okay? And B, you do it because it's only with the people you're surrounded with there, these like people with superpowers, they're the guys that are going to say, yeah, you missed it. Look at this part, like we've just done. So I'm thinking I'd like to monetize an element of that.
I mean, I do some of that macro consulting for people, and I think it's particularly in a macro world like now. It actually didn't matter 3 years ago. We were irrelevant, and you were exactly the right time out of the market because we were just irrelevant. Yes, we saw the flare up in 2015, got interesting, then it kind of died back down again. It's a macro world, so I think it's a very interesting thing because 30 years of experience are worth a lot to somebody else.
I agree. Well, listen, time is precious, and I've taken up a lot of your time, so I'm going to let you go. And I want to say hi to the community. Nice to be here and having this conversation. Instagram, Hugh Hendry official on Instagram. Come on, get over your prejudice, have some fun.
I want to see you in a bikini. We've talked about this.
It's coming. A mankini is coming. Thank you very much.
Hugh, fabulous. Thanks.
If you're ready to go beyond the interview, make sure you visit realvision.com, where you can try Real Vision Plus for 30 days for just $1. We'll see you next time right here on Real Vision.